Question 31. What is the most likely effect of a contractionary monetary policy at the same time as an expansionary fiscal policy? So contractionary, we're trying to slow down economic activity. Expansionary fiscal, we're trying to increase economic activity. So will it A, both aggregate demand and interest rates increase? So aggregate demand will likely increase due to the expansionary fiscal policy, and then interest rates will probably also increase due to the contractionary monetary policy. That's kind of something directly that might be done through monetary policy is increase interest rates to kind of slow down the economic activity. Then we've got B, both aggregate demand and interest rates decrease. Interest rates are going to increase. We can rule out right away for that reason. And then C, aggregate demand increases while interest rates decrease. Again, we can rule out for those interest rates decreasing. And aggregate demand increasing does line up with A, but interest rates do not. So we'll stick with answer A as the best answer here. Question 32. Recovery from a recession is most likely to be preceded by. So preceded by meaning this will happen first. So we're coming out of a recession. What's something that's going to happen before we are kind of come out of that recession? So a reduction in building permits issued and manufacturers' new orders for capital goods. So I think the best way to kind of look at this is if we're recovering from a recession, economic activity levels are low. We'll say we're down here. And then when we're coming out of that recession, we should expect general economic activity to pick up. So it should be increasing. And so if we're seeing a reduction in building permits issued and less manufacturer new orders for capital goods, that's not going to be an indication that we're coming out of that recession. So we can rule out A for that reason. B, an increase in average weekly hours. That would indicate people are needing to work more and therefore produce more goods and services likely, which would mean increased economic activity. So B looks good so far. And a reduction in average weekly unemployment insurance claims. So a reduction in unemployment insurance claims means that more people are employed or the unemployment rate is falling. And so again, like the first part of this answer, that would indicate increased economic activity, which might indicate that we're starting to recover from our recession. So I think B is our best answer so far. Let's make sure we can rule out C. A reduction in the average duration of unemployment and a reduction in consumer credit outstanding to personal income. So on the face of it, these also look like they could be indicators if people are unemployed for a shorter amount of time and they're able to reduce their credit outstanding to personal income. That one could kind of go both ways as well. So on the credit outstanding, this might just indicate that people are spending less. If they're not willing to spend as much credit, they're not spend as much on credit, they're just not spending as much, and they wouldn't be doing that likely if we were coming out of a recession. People are going to be doing that when we're more so going into a recession or in that contractionary phase. And then the tricky part with the first part of this too is average duration of unemployment. This could be decreasing because people are taking jobs that they are overqualified for. So a bunch of people at a Wall Street bank get laid off, let's say, and then they have a short unemployment duration though because they go work at Costco. So I think this question is definitely tricky because these could both be interpreted as positive things coming out of a recession. Less credit to personal income could also mean that incomes are rising. So I think C generally is kind of mixed, whether these are reliable indicators or not, whereas B, increase in average weekly hours and reduction in unemployment claims, those are both going to be more reliable indicators and less kind of open to interpretation than the indicators in answer C are. So we'll go with answer B as our best answer. All right, question 33. Which of the following characteristics is least likely to describe monopolistic competition? So two of these are going to describe monopolistic competition and one is not. So remember what monopolistic competition is. It's where there's essentially a lot of competition in a space. So it's similar to perfect competition in that sense. but it has monopolistic characters in the sense that products can be slightly differentiated. So I think one interesting example to look at in the context of this that we can have in mind as we go through these is something like restaurants. So on the one hand, they're selling the same product being food. On the other hand, they all have maybe slight differentiations based on the type of service they provide or the type of food they serve and stuff like that. So looking at this question through the lens of that type of market, let's look at these answers. So we've got A, high barriers to entry. In a monopolistic competition, there's a lot of different companies or restaurants in this case, but are there high barriers to entries? Not necessarily. I mean, if you're going to open up a huge chain of restaurants and whatnot, that could be a huge undertaking. But if you were just going to be a guy or gal who buys a food truck and serves some food out of your food truck, there's not necessarily huge barriers to entry there. You wouldn't need a ton of capital to get started. So I think A sounds like it could be our answer, but let's make sure we can rule out B and C. B, large number of independent sellers. We can rule that out since that does sound like it's part of monopolistic competition. It's a very fragmented market and there's a lot of slightly differentiated or niche products. So a lot of different sellers. And then C, differentiated and innovative products. We can rule that out since that's the key feature really of monopolistic competition. So we'll stick with A, high barriers to entry, since the barriers to entry will more likely be low. Question 34. Which of the following conditions would least likely need to be present for a large country to increase its welfare by imposing a tariff? So least likely need to be present. So two of these, and by increased welfare, we basically mean country imposing a tariff gets a benefit overall from that tariff. So two of these will be benefits and one will not be. So A, its trading partner does not retaliate. This would certainly be a benefit if you impose a tariff on your trading partner and they do nothing. They don't raise their prices or they don't import less to your country. Then basically you're just getting tariff revenue and the same amount of goods imported. So there's no, that would certainly benefit. B, the exporter reduces the price of its goods. So reducing the price of the goods, this would not increase the welfare of the imposing tariff. If we're increasing the price of our goods, if we're reducing the price of our goods, they might do this to kind of keep market share where the tariff is being enacted at. And by reducing the price of the goods, we're going to have less of a tariff revenue there. And so this could end up hurting us overall. So it looks like B is going to be our answer. And then C, the deadweight loss from a tariff is smaller than the benefit of its terms of trade. And so this is a necessary condition to increase our welfare since it leads in a net benefit. And so we can rule out C as well and stick with answer B here. Question 35. Which of the following is most likely a coincident economic indicator? So coincident meaning it occurs at the same time of the economic activity. So answer A, the consumer price index. CPI is going to be a lagging indicator, and that's because it is backward looking by nature. It tells us what the inflation was in the prior month, not in real time. And so for coincident, we're looking for something kind of in real time. B, the consumer confidence index. This is typically going to be a leading indicator actually versus coincident. And that's because if consumers are more confident, then they're likely to buy more goods in the future. And so by having more confidence today, they're more likely to have more economic activity in the future, meaning it kind of helps predict what people are going to do. And then C, personal income minus transfer payments. This is going to be real-time data, which is what we're looking at for a coincident economic indicator. It's going to show how much money people are earning today, which can tell us in real time if people are earning more money, they'll probably be spending more economic activity. Answer C. Question 36. Richards would like to determine the ability of her regression model to generate price forecasts. She identifies three factors which may be useful in developing a prediction interval. So we've got factor 1, 2, 3, and 4, and those factors are variance of mean construction cost. We've got a number, variance of mean forecasted project price, mean construction costs, and then correlation between mean construction costs and mean forecasted price. Which of the following factors will most likely be required to construct a prediction interval? Factor 1, 2, or 4. So we can kind of just ignore factor 3 for now. And I think the best way to look at this is from the lens of the formula that we'd be using for the prediction interval. So for this prediction interval, it's going to be the slope coefficient, so b hat, and then we're going to be doing plus or minus this value here. And so the TC variable here is going to be the critical value at a two-tailed test. It'll be a two-tailed test since we're doing a prediction interval. We're doing that plus minus. And then we're multiplying that by the standard error of the regression coefficient. So standard error regression coefficient is going to be our standard deviation divided by n, number of observations squared. Square root of number of observations, sorry. So none of these are mentioned in these factors. So we've got correlation. Correlation is not in this formula, and it's not going to be used to find critical value or the standard error. So we've got variance of mean construction cost then, or variance of mean forecasted project price. So we're going to be using one of these to calculate the standard error. We're going to need to take the variance, convert it into standard deviation, and then we'll use that to calculate the standard error. So do we want to use construction costs or forecasted project price? We are generating price forecasts, but we're going to want to we're not taking the variance of our forecast. We're taking the variance of the construction costs. And so this is going to be factor 1 will be our answer, and that's going to line up with answer A. Question 37. An expansionary fiscal policy may most likely include. So expansionary meaning fiscally, the government is trying to do stuff to increase economic growth, activity, and growth. A, reductions in government spending and reductions in taxes. So reductions in taxes is good. That means that people would have more money to spend, essentially, so that should spur more growth. But reducing government spending is going to not lead to expansionary fiscal policy. So we can rule out A for that reason. B, increases in government expenditures, opposite of this answer. That'd be good. That should lead to more economic activity and growth. And increases in tax credits. This should also lead to more growth, since tax credits are kind of similar to a reduction in taxes. They're putting more money in people's pockets that they can spend. So B sounds like our winner so far here. C, reductions in interest rates. Interest rates are going to be monetary policy, not fiscal policy. So we can rule out for that reason. And then increases in government expenditures, that would be good. But even though reductions in interest rates would be expansionary, it's a monetary policy, not fiscal. So we'll rule out for that reason. Answer B. Question 38. Which of the following is most appropriate statement regarding financial assets? A, available for sale securities are reported on the balance sheet at their amortized cost. So they are reported on the balance sheet, but they're reported at fair value, and that's because they are available for sale. So if we're willing to sell them, then they need to be reported at fair value. So we'll rule out A. B, held to maturity assets are stocks acquired with the intent of holding them to maturity. This one falls apart at stocks. Stocks do not mature, so they can't be a held to maturity asset or held to maturity since they don't mature. I feel like I just said mature like 10 times there. But we're going to rule out B. And then C, trading securities are debt and equity securities acquired with the intent of selling them within a short period of time. That is going to be correct. Trading securities can be debt or equity, and we're buying them with the intent to sell. Answer C. Question 39. Which of the following accounting treatments will most likely result in a deferred tax asset? So a deferred tax asset is going to occur when essentially we're paying too much tax today or some type of advanced tax where we're going to have to pay, we're going to be able to use that in the future to pay less tax. So it becomes an asset on our balance sheet because then we're going to be able to offset that against future tax liability. So when we're looking at these answers, we need to understand under which of these scenarios would it be a situation where we're paying more tax today and less in the future based on what happened. So looking at A, revenue is recognized in the tax return for taxable income before it is recognized in the income statement. So if we're recognizing in the tax return for taxable income, that means we're paying taxes on that today. However, we're not recognizing it in the income statement till later. So in that instance, we are paying more today and before recognizing that revenue later. And so this would likely result in a deferred tax asset. Let's make sure we can rule out B and C. B, revenue is recognized in the income statement before it is recognized in the tax return for taxable income purposes. So this is going to be the opposite of answer A. This would lead to a deferred tax liability since we're seeing that income in the income statement before we're realizing it as taxable income. So we can rule that out. And then C, expensive or tax deductible charges are recognized for tax purposes before they are deducted from the income statement. So this is going to, again, similar to B, this is going to lead to a deferred tax liability since we're recognizing these charges for tax purposes before they're deducted from the income statement. So A is the only one that creates a deferred tax asset, so we'll go with A. Question 40. Galactic Hyper is a chain of hypermarkets that sells most of its products for cash, which is why its days of sales outstanding are as low as 22 days. Assuming that the firm's average receivables are $234,000 and the cost of goods sold for the 1 year period is $1.245 million, the annual sales of Galactic are closest to. So our formula here is going to be 365 divided by days sales outstanding, and then we're going to multiply that by our average receivables, which gives us 3.88 million, which rounds closest to answer A. The cost of goods sold is not going to be relevant for this question. Cost of goods sold just tells us what we paid for the items that we're selling. It doesn't tell us how much we are selling. So yeah, pretty straightforward. We'll use this formula, get to answer A.